ever feel like financial bubbles are kind of like, a mystery? I mean, we all know they happen, like the dot-com crash and the housing bubble. Man, those were some crazy times. But what really causes them?
Right.
Today, we're going deep into Morgan Housel's The Psychology of Money, specifically Chapter 16 called You and Me,
Okay.
to understand why bubbles aren't just about people, going a little crazy.
Yeah, you hit the nail on the head there.
Okay.
It's not just about people going crazy.
Right.
It's about a clash of different investor games all happening at the same time. Imagine a room full of people playing poker, but some are playing for pennies,
Right.
while others are betting their life savings.
Oh, wow.
The stakes are completely different.
Yeah. Okay, I see where you're going with this.
Yeah.
So how do these different games actually play out in the real world?
Yeah.
And more importantly, how can understanding them help us make smarter decisions?
Okay, let's rewind to the dot-com bubble.
Sure.
I remember Yahoo back in 1999 at its peak. The company was valued at over $1 billion.
Wow.
To a long-term investor focused on a company's earnings and future prospects,
Right.
that valuation was pure insanity.
Really?
But for a day trader, hopping in and out of stocks in a matter of hours,
Right.
driven by momentum and short-term games,
Gotcha.
that valuation made perfect sense.
So it's like they're speaking different languages.
Yeah.
No wonder there's so much confusion.
Exactly.
And how does this actually influence market behavior?
Right.
How do these different games collide?
Think of it like a seesaw.
Okay.
On one side, you have long-term investors focused on a company's fundamentals.
Right.
They're in it for the long haul, willing to weather market storms.
Yeah.
On the other side, you have short-term traders fixated on quick profits.
Okay.
Now, as short-term gains attract more and more traders, their side of the seesaw gets heavier, pushing prices up,
Okay.
often detached from any real underlying value.
So in a sense, the short-term focus can hijack the entire market,
Yeah.
even if it's based on speculation rather than solid fundamentals.
Exactly. That's when things can get really dangerous.
Oh, wow.
Think of the housing bubble in the mid-2000s.
Okay.
People were flipping houses like hotcakes, buying and selling within months,
Wow.
solely focused on the quick profit.
Wow. So, just to put a number on that,
Yeah.
data from Adams shows that over 100,000 houses were flipped in just 1 3-month period during the peak of the bubble.
Wow.
That's a crazy number.
It is a crazy number.
But were these house flippers really being irrational? I mean, they were making money, right?
That's the key point.
Okay.
They weren't necessarily irrational.
Okay.
They were simply playing a different game
Gotcha.
with different rules and a different time horizon.
Right.
Their goal wasn't to find a forever home.
Right.
It was to capitalize on rapidly rising prices.
Okay.
And within the context of their game, their actions made perfect sense.
Okay. This whole different games concept is starting to click for me.
Yeah.
But here's the question. How do we as individuals figure out what game we should be playing?
Right.
And how do we avoid getting caught up in someone else's game that might not be right for us?
That's where things get interesting.
All right, so we've established that the financial world is kind of like a giant poker table
Right.
with all these different players, each with their own goals and strategies.
Yeah.
But how do we as individual investors navigate this whole crazy landscape? How do we avoid getting caught in a game that's not right for us?
It all comes down to self-awareness, understanding your own investment philosophy,
Right.
your risk tolerance, and probably most importantly, your time horizon.
Okay, so let's break that down. What exactly do we mean by time horizon?
Simply put, your time horizon is the length of time you plan to hold an investment before you need to cash out.
Gotcha.
If you're investing for retirement, 30 years from now,
Right.
you've got a long time horizon.
Yeah.
But if you're saving for a down payment on a house in 5 years,
Okay.
your horizon is much shorter.
Makes sense.
And that difference fundamentally changes the game you're playing.
So how does that difference actually play out in practice?
Right.
Could you give us an example?
Let's go back to the dot-com bubble
Okay.
and that Cisco stock we talked about.
Right.
In 1999, the stock price went from $60 to
Sure.
$600 per share, basically overnight.
Wow.
For someone playing the short-term game,
Right.
riding that momentum wave,
Uh-huh.
it was a chance to make a killing.
Yeah, for a long-term investor, though,
Yeah,
that meteoric rise, it might have set off some alarm bells.
exactly. They'd be looking at the company's fundamentals.
Its earnings,
Yeah.
its growth potential,
Gotcha.
asking themselves, is this price even justified? Can this company sustain this level of growth for the next 10, 20 years?
So the price itself almost becomes a clue about the game being played.
Right.
A high-flying stock with, like, a crazy high price
Yeah,
might be a sign that short-term speculation is what's driving the market.
precisely.
Hmm.
It's like a flashing neon sign saying, caution, short-term momentum at play.
Gotcha.
But those signs can be easy to miss,
Right.
especially when you're surrounded by all the hype and excitement of a booming market.
It reminds me of that old Wall Street adage.
Yeah.
When the shoeshine boy starts giving stock tips, it's time to get out of the market.
Exactly. It's about recognizing when short-term speculation has taken over.
Right.
And the market has become detached from any kind of reasonable assessment of long-term value.
So how do we as, like, individual investors, train ourselves to see those signs? Are there any red flags that we should be on the lookout for?
There are a few things to keep in mind.
First, pay attention to the media narrative.
Okay.
Are headlines screaming about overnight gains and losses? Are analysts fixated on quarterly earnings rather than long-term growth prospects?
So if the focus is constantly on these short-term fluctuations,
Yeah.
that could be a warning sign that the market is being driven by speculation rather than fundamentals.
It's definitely something to be aware of.
Okay.
It doesn't necessarily mean that the investment is bad,
Right.
but it does suggest that short-term thinking is really prevalent.
Yeah.
Which can lead to, increased volatility and potentially really risky bets.
Okay. What else should we be looking at?
Another clue can be the type of investors involved.
Okay.
Are there a lot of hedge funds or high-frequency traders?
Yeah.
These guys are known for their rapid-fire buying and selling.
Yeah.
They often operate on incredibly short time frames, exploiting tiny price differences to make a profit.
So if a particular stock is attracting a lot of these short-term players, it could be a sign that the market is being driven by momentum.
Right.
Rather than, a sober assessment of the company's long-term prospects.
Exactly. And again, it doesn't mean that the stock is inherently bad.
Right.
But it does mean that you need to be extra cautious.
Yeah.
Make sure your own time horizon aligns with the game that's being played.
Okay.
If you're a long-term investor,
Right.
jumping into a market dominated by short-term traders
Yeah.
might not be the wisest move.
This is fascinating stuff.
It is interesting.
It's like you're giving us a decoder ring to understand the hidden language of the markets.
Well, I wouldn't go that far.
Okay.
But I do think it's crucial to remember that investing is not just about numbers and charts.
Right.
It's about understanding human behavior.
Uh-huh.
Recognizing that different investors have different motivations.
Yeah.
Making sure you're not playing someone else's game.
All right, so we've talked about how to identify the different games being played. But the question is, how do we use this knowledge to actually make smarter investment decisions?
That's the million-dollar question.
Right.
That's exactly what we'll be unpacking in the final part of our dive.
Okay, so stay tuned, folks. We're about to learn how to turn this knowledge into action. Okay, so we've spent the last two parts of this deep dive talking about these different investor games.
Right.
And how, recognizing them can really help us avoid buying high and selling low.
Exactly.
Which nobody wants to do.
Nobody wants to do that.
But let's get practical. Yeah. How do we actually use this knowledge to make smarter decisions?
It all starts with aligning your actions with your goals.
Okay.
Once you've kind of defined your own game, your time horizon, your risk tolerance,
right,
you can really be intentional about finding investments that fit within those parameters.
So it's not just about dodging the wrong games, but actively searching for the right ones.
Exactly.
But what does that actually look like?
Okay, let's say you're a long-term investor. You're saving for retirement.
Right.
You've got decades ahead of you.
Yeah.
You're comfortable with some ups and downs.
Right.
And your goal is that slow, steady growth.
Right.
In that case, a diversified portfolio of low-cost index funds might be a good fit.
Now, that makes sense.
Yeah.
Index funds are designed to track the overall market.
Right.
So they're inherently a long-term play.
Exactly.
You're not trying to outsmart Wall Street or pick the next hot stock.
Right.
You're betting on the long-term growth of the economy.
Exactly.
Okay.
But now let's flip the script.
Okay.
Let's imagine someone saving for a down payment on a house, say 5 years out.
Okay.
Index funds could still work.
Yeah.
But the market's short-term volatility becomes a bigger risk.
Right, because if the market takes a dip right before they need that money, they're in trouble.
Yeah, they're stuck.
Their game has a much tighter deadline.
Precisely.
Okay.
In that case, they might favor some more conservative options.
Right.
Bonds, high-yield savings accounts,
Gotcha.
things that really prioritize preserving that capital over shooting for the moon.
Okay.
It's about, tailoring your strategy to your goal and your time frame.
So there's really no, one-size-fits-all approach?
Not at all.
What works for your neighbor might be a disaster for you.
Exactly.
If you're playing a totally different game.
If you're playing a different game.
Right.
And, this kind of brings us to maybe the most intriguing insight from this whole discussion.
Okay.
If most market participants are, fixated on the short term, obsessing over daily fluctuations in quarterly earnings,
Right.
that creates, a really unique opportunity
Yeah.
for those who are willing to play the long game.
Because while everyone else is scrambling for scraps, we're calmly looking for those undervalued gems that others might overlook in their rush for instant gratification.
Right.
It's almost like having a secret weapon.
I don't know about a weapon, but it's definitely an edge.
Right.
Patience becomes a superpower.
Wow.
In a world obsessed with speed.
That's a good point.
Think of it this way, that short-term focus.
Yeah.
It creates noise and distortion in the market.
Yeah.
But for those with the discipline to see through that, there are some incredible opportunities out there.
It's like Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient.
Exactly. It's not about being right all the time.
Right.
It's about having the conviction to stick to your strategy, even when the market gets crazy.
Right.
Over time, quality companies with sound business models, they tend to prevail.
This has been such a great deep dive. I really learned a lot.
Me too.
So as we wrap up, what's the one key takeaway you want our listeners to walk away with?
Don't just play the game. Understand it. Define your goals, your time frame.
Yeah.
And then invest accordingly.
Okay.
And never forget, in a world obsessed with the short term,
right,
patience can be your greatest asset.
And on that note, we'll leave you to ponder that thought.
Yeah.
Until next time, keep learning, keep exploring, and keep diving deep.